Hello and welcome to the Business Today show. I'm Udayan Mukherjee. My guest on the show today not only runs one of India's largest online marketplaces, but is one of the most prolific investors into the Indian digital ecosystem. He has dozens of private equity investments other than the one that he runs himself. So it gives me great pleasure to welcome on the show today Kunal Bahl, co-founder of Snapdeal and also founder of the private equity investment company, or venture capital investment company, I should say, Titan Capital. Kunal, thank you for joining me today and great to have you on the show.
Thank you, Udayan. Nice to be here and thanks for having me.
Well, for people like you, and you're one of a breed of young entrepreneurs who not only run large enterprises themselves, but also invest in so many other startups. So I've always wanted to ask one of you, what gives you greater pleasure, running your own company or dabbling in other people's enterprises?
I think we don't really dabble. I would call it support. It's a good question, Udayan, but look, there is no right or wrong answer to this. Both are very different in their own ways. When you're running your own company, you have a lot more control on the destiny of the business. However, all your eggs are in one basket. Whereas when you're investing, you can vicariously benefit from just learning about so many different industries and building such great relationships with so many founders who are fantastic in their own ways. But you don't have much control on the destiny of any of those businesses. You can support, advise, give them access to your network, but not much else beyond that. So they're both very different, and at least I find myself to be in a very fortunate position where while we have our own operating businesses, but at the same time, vicariously, I can relish the joy of other good businesses getting built out, which are touching the lives of millions and millions of people. The other thing I think which is very important is it also allows one, like an operator like me, to continue to stay relevant, intellectually relevant, because the technology world is very, very dynamic. And it's very easy to become a dinosaur where you live in your own bubble of your own subsector in the technology world, and the winds of change can change on you very, very fast. And so just continuing to know what's going on in the world of software or AI or financial services, etc., or other sectors which may or may not be directly related to one's own operating business, that's hugely beneficial.
But are there pros and cons? The learnings that you speak about from other kinds of businesses, do they overweigh what can become a distraction? Because you invest in so many companies, is it easy to find mind space for all of them, even in a supporting role compared to the pulls and pressures of your own business?
Yeah, I think many other people have achieved a lot more in the same 24 hours that I have. So I feel comparatively, I'm probably doing less justice to the 24 hours I have in the day. But so I don't think I don't think it's as much of a burden in any ways. It does take time from the point of view that there is a sense of responsibility that any investor should feel. When founders who are just starting up take capital from someone like us, they are not only looking for the capital, they are also looking for mentorship, support, etc., which for us and for me is a bigger draw. When I was starting my company 15 16 years ago, along with my good friend Rohit Bansal, there was no mentorship network, there was no support system, there was nothing known as a startup, which is now part of national parlance. It was just a business, and there was no domestic capital ecosystem. And at least the thought process I always had was that if at any point we had the good fortune of giving back to the ecosystem with our time, with our network, with our own learnings, we must, and obviously capital if it's available, we must do that. So it's incredibly fulfilling, it's incredibly gratifying to see that we played a small part in the journey of so many founders who now touch the lives of millions of people in India and around the world.
And it's a great time to be receiving this mentorship that you're talking about, because things are difficult now for the digital ecosystem, right? There's no two ways of putting it. How do you approach your investing philosophy at Titan Capital at this point? I mean, do you look for more exits? Do you become even more fastidious about what you will invest in or not? How are you approaching this phase of difficulty in the ecosystem today?
It's a great question, Udayan. My philosophy in almost anything I've done has always been commit for the long term and be very consistent with what you're doing. Don't do things in ebbs and flows, because then investors in whether public markets or private markets many times tend to invest in waves or focus on timing the market too much. We are investing when the companies we are investing in, there is nothing when we invest. Literally just a couple of founders and a PowerPoint presentation and maybe 1 or 2 months of data, if at all. And so at that stage, there is not much to go by. And we don't try and focus too much on the macro. We try and focus completely on the micro, or for the most part on the micro of, is this team good? Is this space worth building something in? Is there a large opportunity or large problem statement or challenge in this space? And thirdly, does this business have the ability to generate unit economics? Because some of these factors are enduring factors. These phases of funding winter and funding summer and funding spring will come and go. In my own journey as an entrepreneur, I've seen 3, 4, 5 cycles already. And the only certainties are, when there is a good cycle, there is a certainty that a bad cycle will come. And when there is a bad cycle, the only certainty is that another good cycle will come. So I don't try and get too worked up about what cycle we are in, but ensure that we are focused on finding really high quality founders, building large or building in spaces that can potentially create large businesses with good economics. But no doubt it's a challenging time, but it's also a much needed reset for the ecosystem, or a recalibration more than a reset for our ecosystem. And as a result of which, I'm very confident that we're going to create many more healthy companies in our startup ecosystem.
This recalibration, I mean, that's what everybody is talking about. That earlier, even a year earlier, everybody was focused on building out the business, getting more market share, not be too fussed about profitability at this point. Now that whole thing, that orientation seems to have changed. Now there is a rush to become profitable because the pipeline of cash is sort of drying up. I mean, at your own level at Snapdeal and the companies that you've invested in, do you see this orientation being actually affected in reality, or is it easier said than done? It's not just a switch that you can put on just like that.
The question is absolutely on point. The answer is a bit complicated, however, given a business's ability to become profitable is, there are so many factors at play. There are competitive factors. Sometimes there are businesses that have no revenue today. So there is no framework in which those businesses can become profitable at all. Or they have very minimal revenue compared to their very large cost structure. Not because there was imprudence necessarily, because I think enough is said about imprudence with spending. But it's also because some businesses just require a bunch of front loading of investment before they actually can get to significant revenue and thereafter profit generation. I think there is a lot already said about the startup ecosystem burning money and losing money, etc. But there's also a fundamental nuance, I should say, between how the investments are viewed in the startups versus they're viewed in, let's say, traditional sectors. Where in traditional sectors also there are sizable investments, right? Whether it's toll roads or steel or ports or other kind of refineries or other kind of large infrastructure, there is front-loaded investment there too. But those usually go through the balance sheet because their hard assets need to be created. Whereas in businesses in the technology world, typically all the expense goes through the P&L, which shows up as what is now colloquially known as cash burn. And as a result, one should appreciate that in both type of businesses, there are some assets being created. In the former, these are hard physical assets, atoms essentially. Whereas in the latter, you're writing software, which is usually not capitalized, it's expensed. You are spending on acquiring customers for a new type of service you've created. So while you've paid all the money to acquire the customer today, but the customer will give you dividends in terms of spending more on your platform or your products over a period of time, 1 year, 2 years, 3 years. But all the expense of marketing and acquiring that customer has been incurred today. So one needs to appreciate that not all cash burn is necessarily terrible, bad, and needs to be cut to the bone, because some of it is actually real investment in building a lasting, enduring company.
No, fair point. But let me drag it from the general to the more specific. Like take the example of Snapdeal. You are not in a situation where you don't have revenues. I mean, last year you had what, nearly 600 crores of revenues, but you also had more than 400 crores of losses. Now, how quickly can you pare those losses down in the light of the new market realities? I mean, for a company like Snapdeal, when can you cut 400 crores of profit and drag it back to a profit or close to a profit?
Yeah, I feel that there is a trade-off one needs to make in any business if you want to get to profitability faster. And the trade-off is around growth and scale. And at least my view is that in a market which is capital constrained, where capital for growth may not be easily available, it's important for companies to take the call that, hey, I'm going to first make sure that I get to profitability. And once I get to profitability, I will figure out ways to grow from there. And that's been our approach. And that's been the approach that most companies are taking in the ecosystem right now. Given it's important to be in control of your destiny before you embark on major growth initiatives, particularly given the larger macro environment right now.
Right. Now you use the word capital constraint. I mean, the capital constraint is not just from the fact that private equity players are becoming tight-fisted given market conditions. It's also how much money you can tap from the equity market, for example. I mean, you had a very large IPO lined up and that did not go through because of market conditions. So from your perspective, when is the next window of opportunity which opens up for the Indian digital ecosystem, say from an equity market point of view, where you can tap and access more capital?
Yeah, I wish I knew the answer, Udayan. I think even if I hazard a guess, it's at best an uneducated guess because I am no expert in the capital markets. I do feel, though, looking at now the history of some of the companies in our ecosystem that have listed, there is a clear indication that the market has given that what they want is, whether you're a digital business or not, profitability and cash flows matter. And that age-old wisdom around Indian public markets, like cash generating businesses, is holding true whether you're a digital or a digital migrant business, digital native business, or a non-digital business, if I may. And I think that has been a valuable learning for the entire ecosystem, and which is why it's no surprise that companies across the board in our ecosystem are optimizing for profitability, because everyone realizes that, look, eventually there will be some amount of M&A in the private markets, but unless enough number of companies in the tech sector which are private today list in the public markets in India and have a very successful listing and build lasting, enduring public companies generating cash flows, growing their valuations, and rewarding shareholders. Unless that happens, there is almost like a ceiling that will exist, which the private companies will keep running into in terms of their own valuation growth, in terms of their own attractiveness to growth investors. So in summary, I feel that the answer is not in when the markets will open up. The answer is when will the companies in our sector be ready with generating enough cash flows, enough profits that the public markets find them more enduring and valuable.
So Kunal, you spoke about this valuation ceiling. I mean, I've always wanted to ask how you grapple with a business model which is in many ways intrinsically dependent on the cash that you can raise given a certain level of valuation. But this valuation thing is an ever-changing thing. Like maybe in 2015, you had a $6 billion valuation. You were going to do an IPO with a valuation which was closer to $1 billion. And now I don't know what the valuation of Snapdeal is. So how do you plan for the future when the basis of your currency is constantly changing?
Yeah, I think, look, valuation, by the way, I don't think there was any indication on what our IPO would be valued at, given that's something the markets would have eventually decided had we moved forward. That said, look, valuations are volatile. They are volatile in public markets, as we've seen in the public US public markets with respect to tech, where $100 billion companies are worth $15 billion right now, and these are high quality companies with enormous amounts of profits. So there is volatility in valuations. There always has been. There always will be. The volatility exists in public markets. The volatility exists in private markets as well. And as operators, as founders, and even as investors in private companies, one doesn't have as much control on them because there are so many moving parts that determine valuation. Sure, all founders and all investors who are investors in a company would want valuations to only go in one direction. However, the last year or year and a half has been a moment of reckoning for the global tech ecosystem, where particularly in private markets, we had a run post 2008, 2009, once interest rates started falling dramatically, where private company valuations only went in one direction. I think we are now seeing a slightly higher correlation to reality, where there are all kinds of factors that come into play to determine a company's valuation. And sometimes it can go up, and sometimes valuation can come down, and it can again go up thereafter. The key lies in the actions and the inputs of management teams, which is essentially trying to optimize for profitable growth.
No, I ask you this question because it is, I mean, for a company like Snapdeal, which is battling with, much better funded giants like Amazon on one side, Flipkart now with its new owner, how do you come around or grapple with the problem of constantly finding more capital to throw at a business just to stay in the same place to be competing with very large players?
Yeah, it's a good question, and obviously, it's a very logical question to ask. That said, Udit, if you think about it, almost every space, every sector, whether it's a digital or a non-digital sector, has dominant, well-funded players. That doesn't mean there is no space for anyone else. India's retail market is 1 trillion, going to 2 trillion, and then 3 trillion. There is enough space for multiple companies. The key lie, and also India, as you know, India's consumer market is incredibly heterogeneous. There is no one size fits all. We are almost, we are made up of multiple cultures and multiple buying behaviors within the same country. It's not the same type of customer and same type of product needs and service needs everywhere. So being very clear about, hey, what do we stand for and how is that differentiated from other market players is very crucial. Like, for instance, in our Snapdeal business, it is very crucial, very clear that, hey, we are only focused on the value segment, where we are going to provide quality merchandise, which is in a narrow price band, focused on small town consumers who belong to small towns. And we ensure, as a customer promise, we provide free shipping on everything we sell. What that does is it clearly delineates affinity towards the platform in a certain large segment of the market. And despite the fact that there has been a lot of competition in the ecosystem for now many years, we've held our own, and we have millions and millions of customers who buy from Snapdeal every month. And the reason is that our proposition to that audience is actually very sharp. Similarly, in our one could argue that in our software business, Unicommerce, which powers the logistics software for a lot of e-commerce brands and digital migrant brands, like offline brands going online. There are lots of software companies also. There are lots of large IT companies also who provide similar software. But that business, this is already processing over 700 million e-commerce orders a year, and is also profitable last 4-5 years of its existence. How is it able to do that? Because it is very specialized, it's very focused, that this is a problem we will solve, and we'll solve it better than anyone else in the market for the customers who want it. And these are problems we'll stay away from because maybe we don't like the economics of those problems, or maybe those problems are addressed already by multiple players where the economics aren't that great. So being very focused and disciplined on who you're solving for and how you're solving it and how you're setting up your capabilities to win in that segment is really what differentiates a company.
So you don't subscribe to that line of thought, which a lot of people or analysts seem to say that eventually, I mean, regardless of how you position yourself, there'll be only two players standing in that space, one global player, one national player, and they will be the two online marketplaces left. Clearly,
Well,
you disagree with that line of thinking.
I think it's not about, we are all entitled to our opinion, but maybe not to our own facts. Where the facts are that in every sector, whether technology or non-tech, there are usually multiple players. There may be a few really large ones, but that usually has never precluded other players who are also sizable to exist, and that holds true for e-commerce. It holds true for social media. It holds true for software or almost any type of business. One can't point to only one or two players in any market who are the only standing players. It just Those are the facts.
With the benefit of hindsight, Kunal, does it ever occur to you or strike you uh, on a bad day at work that maybe it would have been good if that merger with Flipkart had gone through in 2017? Do you ever think like that?
No, actually, I don't. And you know, oftentimes it's only in some external conversations people may remind me of the past, but honestly, I spend no time thinking about the past. There's so much to do. There's so much opportunity. We have um, we have a consumer market in India, which is so deep. We have an e-commerce market, which has so much potential. And we have a business which is strong and is catering to the needs of the segment we are focused on in quite a focused and differentiated manner. So I guess the simple answer is don't think much about the past because there's just so much opportunity to focus on in the future.
We were speaking about Amazon and Flipkart. On that subject, I want to ask you whether how this ONDC can mix up things and what it means for a player like Snapdeal, because you've enlisted on that platform. I
Yep.
mean, you're getting business from there. Do you think it could be a potential game changer?
It can be. Look, I remember the early days of UPI, Udayan, where nobody used it. Everyone thought that only wallets will exist, and what is this UPI thing? Nobody would want direct debits to be happening to their bank accounts. There would be a, maybe if not a practical risk, but a perception risk that money was getting deducted straight from your bank account, and tomorrow if someone takes that money away, etc., which was one of the resistance consumers always had using debit cards for POS transactions. They would use debit cards for ATMs, but not for merchant transactions for that very reason. There were 100 different reasons given for why UPI won't work, and the banks would never allow it. The zero take rate would never sustain for beyond the 6 month or 12-month promotional period. I can tell you there were more arguments about why it would not work, and there were very few arguments for why it would work. And we know what happened thereafter, where now not a day passes where I'm not making multiple UPI transactions, and I know that's true for most people around me. What if ONDC is that for e-commerce? We don't know whether it'll be. It may be, it may not be. Time will tell. But what if it is that for e-commerce in India? And in that case, we must definitely be a part of it, and we must support it to the extent we can as a leading domestic e-commerce company. That's sort of been our mindset, Udayan, around ONDC. We feel there is a lot of promise, there's a lot of potential. There is the entire might of the entire government machinery and other ecosystem players behind this. We must come together as an ecosystem to try and make it work. It is still early days, and we'll see how things play out. but I'm cautiously optimistic about the future of ONDC.
Well, Kunal, it's been great talking to you today, and my compliments on what you've achieved so far, and my best wishes for not just Snapdeal, but for all the many investments that you make at Titan Capital. All the very best, and thank you very much.
Thank you, Udayan. Take care. See you.
If you like the video, do like, comment, share and subscribe.